Good morning/afternoon, everyone. Today, I will present my project titled Dynamic Multi-Asset Allocation Using PPO and Smart Money Concepts. This project combines three major components: financial market analysis, reinforcement learning, and system implementation. The main goal is to build an AI-based investment system that can dynamically adjust asset allocation according to market conditions, while also providing a dashboard to make the model's decisions more observable and interpretable. Recent years, with the rapid development of generative AI, high-performance computing, and financial technology infrastructure, quantitative trading and intelligent investment have become increasingly important in global financial markets. Investment decisions are gradually shifting from human intuition to data-driven and model-driven approaches. As a result, using AI models to process market data and automatically generate investment strategies has become an important research topic in financial technology. The algorithmic trading market and quantitative trading platform market are both growing steadily. This indicates a rising demand for backtesting engines, automated trading systems, data platforms, and AI-based investment models. In other words, financial decision-making is increasingly supported by automation and intelligent systems. This trend provides the motivation for this project, which focuses on AI-based dynamic asset allocation. In recent global markets, AI and semiconductor-related stocks have become major areas of capital concentration. Companies such as NVIDIA, AMD, TSMC, Micron, and Microsoft are closely related to AI computing, data centers, high-performance chips, and cloud infrastructure. These assets have strong growth potential, but they also come with high valuation risk and high volatility. Therefore, they are suitable representatives of the risk-on assets in this research. AI growth stocks may generate strong excess returns, but they can also experience sharp corrections when market sentiment changes. A simple buy and hold strategy may expose the portfolio to significant drawdowns. Therefore, the key problem of this research is not only predicting which stock will rise. Instead, the goal is to dynamically allocate capital among risk-on assets, risk-off assets, and cash, so the portfolio can participate in strong markets and reduce exposure during weak markets. Traditional asset allocation methods, such as the Markowitz mean variance model, determine asset weights by balancing expected return and risk. These methods have a clear theoretical foundation and can provide diversification benefits in stable market environments. However, when markets experience structural changes, extreme volatility, or sudden shifts in asset correlations, traditional models may not respond quickly enough. As a result, static allocation strategies may be insufficient for today's highly dynamic financial markets. Traditional technical indicators also have limitations. Indicators such as RSI and MACD are mainly calculated from historical price data, which means they often generate lagging signals. By the time these indicators produce a buy or sell signal, the main price movement may already have occurred. Therefore, this research attempts to introduce features that better reflect market structure and institutional behavior, rather than relying only on traditional indicators. Gold and long-term treasury bonds are commonly considered safe haven assets. However, in real markets, their hedging effectiveness is not always stable. For example, gold may perform well under certain levels of market fear, but its effectiveness can weaken under extremely calm or extremely panic-driven conditions. Similarly, long-term treasury bonds are highly sensitive to interest rate expectations. Therefore, this research does not use a fixed stock-bond allocation. Instead, the model dynamically decides whether to allocate capital to GLD, TLT, or cash. Based on the previous background, this research focuses on four main questions. First, how can smart money concepts, which are often used in discretionary trading, be transformed into quantitative features? Second, how can these features be integrated into the state space of a reinforcement learning environment? Third, how can PPO be used to output multi-asset allocation weights? Finally, how can a microservice-based dashboard improve the observability and interpretability of AI investment decisions? The objective of this research is to build a complete AI asset allocation framework. At the model level, this project designs a multi-asset reinforcement learning trading environment and trains an agent using PPO. At the feature level, this project transforms SMC concepts such as BOS, change, order block, and fair value gap into structured state features. At the system level, this project builds a microservice-based trading dashboard using Spring Boot and React to visualize portfolio weights, performance, and risk indicators. The first category of related work is traditional asset allocation theory. Early studies were mainly based on modern portfolio theory, which uses the mean variance framework to balance expected return and risk. The advantage of this approach is that it is theoretically clear and easy to explain. However, it usually assumes that return distributions and covariance structures are relatively stable. When the market changes rapidly, this assumption may no longer hold. The main gap in traditional methods is that they usually rely on aggregated indicators, such as price, return, volatility, and asset correlation. These indicators are useful, but they do not explicitly describe market microstructure or institutional liquidity behavior. For example, liquidity sweeps, false breakouts, structural breaks, and key order zones are usually not represented in traditional asset allocation models. Therefore, this research introduces SMC-based structural signals to provide a more detailed view of market conditions. The second category of related work is the application of deep reinforcement learning to asset allocation. In this approach, the investment problem is modeled as a sequential decision-making problem. At each time step, the agent observes the current market state and decides the portfolio weights. The agent then learns a policy by maximizing long-term cumulative rewards. Common methods include DDPG, PPO, and actor-critic architectures. This research selects PPO as the core reinforcement learning algorithm because it is suitable for continuous action spaces and provides stable policy updates. In multi-asset allocation, the model does not simply choose between buy and sell. Instead, it needs to output the allocation ratio for each asset. PPO can directly learn this type of continuous weight decision through policy gradient optimization. Its clipped objective function also helps prevent unstable updates during training. Although deep reinforcement learning has been widely applied to asset allocation, most existing studies still rely on price data, technical indicators, fundamental factors, or asset correlations as state features. These features are useful, but they may not capture how institutional liquidity behavior appears in price structure. As a result, the model may fail to detect false breakouts, liquidity sweeps, or changes in market character. This is the main reason why this research incorporates SMC features into the reinforcement learning environment. The third category of related work is smart money concepts, or SMC. The core idea of SMC is to analyze market structure, liquidity zones, and order distribution in order to infer possible institutional activity. Common SMC concepts include break of structure, change of character, order block, fair value gap, and liquidity sweep. These concepts are often used by traders to identify trend continuation, trend reversal, and potential support or resistance zones. The value of SMC is that it does not only focus on whether price is going up or down. Instead, it focuses on the structural meaning behind price movements. For example, BOS may indicate that an existing trend structure has been broken, while CHOCH may suggest a possible change in market behavior. Order blocks may represent areas where institutional orders were placed, and fair value gaps may indicate price imbalance. These features may provide more forward-looking information than traditional lagging indicators. However, SMC also has an important limitation. In many cases, SMC analysis is still highly dependent on trader discretion. Different traders may define order blocks, BOS, or CHOCH in slightly different ways. In addition, SMC is mostly used for single asset trading or discretionary decision support. It has rarely been systematically integrated into a multi-asset reinforcement learning framework. Therefore, this research attempts to standardize and quantify SMC features so they can be used as model inputs. Next, I will introduce the proposed method.
First, historical market data is collected from multiple assets, including price, return, and volatility information. Then, SMC structural features are extracted from the price series. These include FVG distance, order block touch status, and BOS or CHOCH direction. After that, the features are integrated into the reinforcement learning state space. The PPO model then observes the state and outputs portfolio allocation weights.
The asset pool in this research is divided into 3 categories. The first category is risk-on assets, which mainly include AI and semiconductor-related stocks. Examples include NVIDIA, Micron, TSMC, AMD, and Microsoft. These assets are selected because they have strong growth potential and are highly sensitive to AI industry trends and technology sector capital flows. When the market is strong, the model can increase exposure to these assets to pursue higher returns. The second category is risk-off assets, including GLD and TLT. GLD represents gold exposure, while TLT represents long-term U.S. Treasury bond exposure. These assets are used to reduce portfolio volatility when market risk increases. The third category is cash. When stocks, bonds, and gold are all under pressure, or when the model detects weakening structures across multiple assets, it can increase the cash position to control drawdown and preserve flexibility for future re-entry. In reinforcement learning, the state space represents the information observed by the agent at each time step. In this research, the state space includes not only traditional features such as price, return, volatility, and VIX, but also SMC-related features. For example, FVG distance percentage indicates how far the current price is from an imbalance zone. Order block touch status indicates whether price has revisited an important institutional zone. BOS and CHOCH help the model understand whether market structure is continuing or changing. The action space represents the decisions that the model can make. In this research, the PPO model outputs continuous allocation weights for all assets. This means the model does not simply decide to buy or sell. Instead, it decides how much capital should be allocated to each asset. To ensure that all weights sum to 100%, a softmax transformation can be applied to the model output. For example, in a high-risk environment, the model may reduce exposure to NVDA and AMD while increasing exposure to GLD, TLT, or cash. The reward function is the core mechanism that guides the reinforcement learning agent. If the reward only considers portfolio return, the model may overemphasize short-term profit and take excessive risk. Therefore, the reward function in this research considers multiple factors. These include portfolio return, maximum drawdown penalty, transaction cost penalty, and slippage penalty. This design encourages the model to pursue returns while also controlling risk and avoiding excessive trading. This research uses Python to build the reinforcement learning trading environment. The environment can be designed using the Gymnasium interface and trained with Stable Baselines 3. At each time step, the environment provides the current market state to the model. The PPO agent then outputs portfolio weights. The environment updates the portfolio value based on the next period price movement and returns the reward and the next state. Through repeated training, the model learns how to adjust allocation under different market conditions. In addition to model training, this research also emphasizes system implementation. Therefore, the overall architecture is designed as a microservice system. The system separates AI computation, data services, signal services, backtesting services, and the dashboard front end. The AI engine is responsible for model training and inference. The API gateway provides unified access to data and strategy results. The front-end dashboard is built with React to visualize the model status and portfolio performance. The back-end services are responsible for data management and strategy result delivery. For example, historical candlestick data, SMC signals, portfolio weights, trading logs, and backtesting performance can all be provided through back-end APIs. Spring Boot is used as the API gateway because it provides a clear and scalable way to manage service endpoints. This design also makes it easier to extend the system in the future by adding new models, new data sources, or new trading services.
The purpose of the React dashboard is to improve the transparency of AI investment decisions. The dashboard can display current portfolio weights, equity curve, cumulative return, maximum drawdown, Sharpe ratio, and SMC event markers. For example, when the model reduces risk-on exposure, users can observe whether choke, liquidity sweep, or rising VIX signals appear at the same time. This makes the model less like a black box and more like a decision system that can be monitored and evaluated.
To evaluate the effectiveness of the proposed method, this research will conduct multi-year backtesting using historical market data. The backtesting period should cover different market regimes, such as AI growth periods, interest rate hiking cycles, technology stock corrections, and high volatility markets. The evaluation metrics include cumulative return, annualized volatility, maximum drawdown, and Sharpe ratio. These metrics will help determine whether the PPO plus SMC strategy can outperform baseline strategies in both return and risk control. To conclude, this research has 5 expected contributions. First, it quantifies smart money concepts as reinforcement learning state features. Second, it uses PPO to build a dynamic allocation model that can output continuous portfolio weights to improve risk control across different market conditions. Fourth, it adopts a microservice architecture to improve system scalability. Finally, it uses a React-based trading dashboard to improve the transparency and interpretability of AI investment decisions. Overall, this research aims to provide an AI asset allocation framework that integrates investment strategy, risk management, and practical system implementation.